Hi, I'm Craig Standen, Director of Healthcare Advisory Services, and thank you for joining us. In today's video, we'll focus on the importance of using enterprise risk management, or ERM principles, as an integral part in the development and implementation of effective investment management programs. In the wake of the 2008 financial crisis, many organizations, healthcare providers included, are focusing more time and attention on developing and implementing ERM processes to be better positioned to withstand the impact of macro systemic shocks and to respond appropriately should similar events occur in the future. Healthcare providers and all organizations must take risks to grow and add value. Knowing this, management and boards are more closely aligning strategy development with a clear understanding of the associated risks. At a high level, ERM is a systematic process that closely aligns strategy, operations, finance, and treasury functions. And at its heart, ERM is focused on the identification, quantification, and management of organizational risks. There are a number of ERM models or constructs, and as this graphic shows, identifying risk exposures is the starting point. Financial forecasting incorporates risks that have been identified and quantified. Scenario development and stress testing will illustrate various outcomes using a range of environmental and operational inputs. And note that the arrow between strategy development and stress testing and financial forecasting goes both ways, as this step provides a feedback loop that can and likely does impact financial forecasts. In truth, many healthcare organizations adjust budgets at various levels of their organizations as factors impacting outcomes are identified. The process continues with ongoing monitoring of identified risks and, as required, strategy modification. For healthcare providers, there are four main components of enterprise risk. Unrestricted liquidity provides operating and working capital. It has long-term growth expectations. It supports strategic objectives, including capital spending requirements as a working asset for the organization. It supports maintenance of a positive net financial margin, which represents investment earnings in excess of the organization's cost of capital, and it carries risks associated with the allocation strategy. Capital structures of many healthcare providers are composed of various forms of debt capital, i.e. fixed rate, variable rate, or hybrid structures, each of which has their own risk profiles. Interest rate sensitivity, both for debt and any interest rate swaps, is an important risk consideration. In addition, financial covenants require providers to consistently meet defined financial performance thresholds or risk of potential debt default. And the rating agency views on organizational capital structure risk will factor into a credit rating and impact a provider's cost of capital or access to capital. Operations and capital budgeting risks encompass competitive positioning activities, execution of strategic initiatives, including spending needs, and an organization's response to the Affordable Care Act, which drives financial performance both current and forecasted, and the attainment of a desired rating level. Healthcare providers with defined benefit plans have an additional set of risks. Contribution requirements impact cash flow, and depending upon the size of the organization, if the plan is significantly underfunded, the pension liability could represent a material percentage of total liabilities. The plan is subject to interest rate sensitivity from the standpoint of the discount rate used to determine benefit obligations and earnings on plan assets, and providers have certain risks associated with their particular objectives for the plan, specifically maintaining the plan or moving through a process resulting in the plan's termination. Turning to investment strategies, it is important to take a broader viewpoint and evaluate the performance and the impact of portfolio allocation strategies in terms of strategic financial metrics. Stochastic modeling is an important analytical tool to evaluate the impact of asset allocation decisions on financial performance and more closely aligns those decisions to broader goals and objectives. SEI recently conducted an asset allocation study for a large Midwestern healthcare organization with over $2 billion in total operating revenue. The primary objectives of this study were twofold. One, determine if the organization's asset allocation across multiple pools comprising their total unrestricted cash and investments was appropriate and in line with their risk appetite. And two, determine if the allocation strategy supported the health system's goals and objectives given their unique set of financial circumstances. Some of the considerations taken into account included how reliant was this particular provider on investment returns for organizational growth and operational support, and does the asset allocation expose the organization to unacceptable risk, and what is the potential impact of the allocation strategies on the health system's key credit and financial metrics. Using two sets of multi-year financial projections provided to SEI by the health system, a baseline or expected case, and another case exhibiting a more stressed operating profile, a comprehensive range of financial and operating data, and SEI's capital market assumptions, our stochastic modeling generated probability distributions of expected outcomes, of returns on and growth of the total portfolio, as well as their key financial metrics under a range of economic environments, which ultimately highlighted for the health system the risk-return profiles of potential asset allocation strategies. Ultimately, SEI's asset allocation study revealed that based on the financial forecasts and the associated assumptions, the health system's current risk profile is in line with their risk appetite. The projected growth and returns on the portfolio are expected to maintain their key financial metrics, and the expected returns are sufficient to support the health system's strategic initiatives and grow their balance sheet. And finally, our simulations also revealed that the organization's overall credit profile is expected to improve over the forecasted period. For more information on this particular asset allocation study, or if you have any questions, please email institutions@seic.com. SEI is able to conduct a financial management analysis for your organization that can quantify risks of your investment strategy. Thank you.